I wanted to do something that was really fun, but also condense my entire 25-year career into a set of 25 slides. So hopefully we will try and achieve that successfully. So moving on to, all right, so if we go on to the role of, so just hold on a second. I just want to get my, can you just turn that here? All right. Yeah, okay, perfect. All right, so you see a slide in front of you which says the role of the financial sector is to connect savers to borrowers and facilitate economic growth. The financial sector plays a very important role in the functioning of the economy, what we refer to as intermediation. Simply put, the financial sector sits between what we refer to as savers and borrowers. It takes funds from savers, for example, through deposits and lends them on to those who wish to borrow. Those can be households, individuals, businesses, government. But in order for this sector to remain stable, it needs to have a very healthy financial sector. And so therefore, the sector plays a very critical role in the economic development of any country. The sector in South Africa also contributes fairly significantly towards GDP, and the ability to allocate capital, to monitor and provide finance for investments, risk management, the mobilization and pooling of savings are some of the benefits of a well-developed financial system. So if we see that graphically, can you go on to the next slide? All right. So if we look at this graphically, you can clearly see the role of intermediation facilitating the efficient allocation of capital and thereby supporting economic growth and resilience. The sector has lots of different types of entities, savers, businesses, households, and government. They would go to these different types of entities, which are banks, investment banks, insurers. Then we've got retirement funds and asset managers who play a key role in providing a debt and equity to institutions. And then basically the cycle goes around again. The sector is very important in the sense that it provides broad access to financial products and services. It must be trusted. For that reason, it must be trusted. It must be well regulated, because safeguarding the savings of ordinary South Africans, as well as providing financial protection through insurance, risk transfer, and diversification are the core functions of any good financial system. And it must be efficient to be able to facilitate economic confidence and ensure stability in any economy. And we will talk a lot about this later on, as the financial sector regulations has changed fairly significantly in the past couple of years. South Africa has moved towards strengthening oversight and prudential requirements as part of an effort to overhaul the entire financial system to become a lot more resilient and enable it to sustainably contribute towards economic growth and prosperity. If we move on to the next slide, I'm going to actually load all of the information at once so we can actually discuss it. So what I did here was I wanted to give you an idea of the size of the total South African savings and investment sector, excluding the capital that is held by banks. And the number that I come out to is around 7.6 trillion rands. And the real purpose is to calculate the stocks of financial assets that have been accumulated in the financial system over many, many years, which basically include investment income as well as capital growth and on portfolio investments. So as I mentioned a few moments ago, the financial sector in South Africa and the system is extremely well regulated. And it's important that it's well regulated because it needs to provide the confidence that is necessary for individuals businesses and the public sector to entrust their funds into the system. Now, financial returns are basically achieved through investment in all these items listed in the black bar at the bottom. People invest in cash in banks, shares in companies listed on the JSE, and in the government through sovereign debt, investing in state-owned enterprises, debt in corporate bonds. However, most South Africans cannot access those investments directly. And so they invest through regulated products and entities on a pooled basis. And that's where the unit trust industry comes to play, as well as retirement funds. So if you look at the value of all the money invested in the unit trust sector as at the 31st of March 2020, that was around 2.3 trillion rands. And remember, that was a decline after the volatility we saw as a result of COVID coming into February and extending into March, where we saw the JSE decline in excess of 20%. The total stock of retirement fund assets, excluding the government employees pension fund, sits at around 2.6 trillion rands. We will talk about that later on and how we get to that breakdown. And then, of course, the assets of the Public Investment Corporation is largely that of the Government Employees Pension Fund. The insurance sector holds significant capital and assets on behalf of the public and for capital adequacy purposes. And so if we add all of that money and we take away any kind of double counting, we get to the value of 7.5 trillion rands, which is invested in what we refer to as the capital markets. And the capital markets is the equity and bond markets, and then, of course, the unlisted markets. It's very, very important to note that retirement funds in South Africa hold a sizable chunk of all the equity and bond holdings. And the growth of assets under management here is highly correlated to the liquidity and depth of our bond and equity markets. So retirement funds in South Africa have been a critical driver of the development of capital markets, which we will also demonstrate to you in a moment. So moving on to, and I just want to warn you here, because some of the graphics displayed here can be fairly offensive and hurtful as they represent our painful past. However, our past is relevant in the context of the financial system, as many of the laws and the functionality of the system was influenced so much by this past. I've attempted to condense around 400 years of events that have shaped our present day financial system. So let me take you back in time, and I want to give you a history of the financial system over the past 400 years in the next 4 slides. So if we move to the history of the financial sector, and I've broken it up into 6 different periods because I feel that each different period influenced regulatory and economic activity fairly differently. And if we move all the way back to the period 1652 to 1909, which was largely the period of Dutch colonization, the Anglo-Boer Wars, the British rule, and most importantly, the Kimberley Diamond Rush and the Witwatersrand Diamond Rush really spurred around 68 companies listed on the JSE, and by the end of 1890, there were around 300 companies listed on the JSE. What I find most ironic about it is that currently, at present day, we have just over 300 shares listed on the JSE. So nothing much has moved since 1887, since 1890. The first formal pension fund is recorded as being established in 1882, and that also paved the way for the institutionalization of the retirement fund sector. And then, of course, we saw the first bank and the life insurance company established during that period as well. Moving on to the next kind of a big political era was when the ANC was founded. South Africa became a state in the Commonwealth, and the Union of South Africa was established. And Moleke and Ikeid from the University of Stellenbosch have done some phenomenal work on the history of the retirement fund sector in South Africa. And what really started up today's Public Investment Corporation was the Public Debt Commissioners Act. It's gone through several iterations over the past couple of decades, but in 1911, this act was passed. And this act really marked the beginning of what is presently known as the PIC. This act made provision for holding state assets, using them to finance government budget deficits. It functions over the next few days, expanded into the provision of loans to government, state-owned entities, Iron and Steel Corporation, the South African Broadcasting Corporation, the Water Supply Corporation. It was basically a single government entity that was able to manage and control government funds. The pool of government money was a tool for government to borrow from itself. And this is also a debate that comes on 100 years later when we talk around the issue of prescribed assets, which got a lot of headway at the 1917 pre-ANC election manifesto launch. If we move on then to the worst part of our history, which is really the National Party's policy of apartheid and racial segregation. But what was also important of that period and an act that it has gone through several iterations, but it was the formalized structure of the pensions industry when we saw that a registrar for the pension fund industry was appointed. The institutional and regulatory framework for the sector was put in place. It established a regulatory institution that was set in motion to regulate pension funds, and the definition of pension funds was introduced. Pension funds started reporting on assets and liabilities, number of funds, types of funds, members, amounts paid as contributions, and also the different breakdowns between private sector and public sector retirement funds. Interestingly, no, that was the official period of the collection of data for the retirement fund industry, which started being recorded from the period 1959 to date. If we move on to the next critical period for the savings sector, was the period 1960 to just before democracy. We saw our first unit trust launched in 1965 by a company called Sage, which some of you may remember. But most importantly, we have to talk about the apartheid legislation, which polarized Africans from the formalized savings environment and how we were allowed to save during that environment. And in fact, the remnants of that legislation still exist, where in a lot of sectors in South Africa, you would find 2 retirement funds per company, where the one retirement fund was for the white bosses, and the other retirement fund was established for African workers. And that really caused an uprising within, naturally so, within the savings space. And trade unions pushed towards establishing their own schemes, which were for the unions and influenced for the benefits of trade union employees. And this saw a major shift to the move from defined benefit funds to defined contribution funds. But we also saw a shift away from pension funds to provident funds, which was largely supported by the trade union movement. The next stage towards the PIC was the Public Investment Commissioners Act in 1994, and they took over the role of public funds and debt provider to government. Its core role was to maintain a close relationship with the apartheid government and fulfilling that specific mandate. But that Public Investment Commissioners Act only invested in bonds and the fixed interest markets. And only in the 1990s, we saw the first equity investments starting to be implemented. But before that, it was largely in the fixed income markets. So this, of course, is where we saw most of the activities, where we saw most of the amendments and reform in the financial sector come into play. Firstly, we saw South Africa become a member of the G20, and till today, a lot of our financial sector regulations are influenced by South Africa's role as a member of the G20. We saw anti-money laundering legislation coming into play. We saw the FSB Act coming into play, Black Economic Empowerment. And then, of course, we saw the establishment of the Public Investment Corporation, where the PIC Act basically transferred all the assets to the PIC. The state assets would be derived from the Government Employees Pension Fund, as well as other state entities such as the Unemployment Insurance Fund. The state basically remained in control of the fund as it attained its status as the sole shareholder through the Minister of Finance, to whom, even to present day, the Board of Trustees would be accountable. So the PIC manages the government funds, but is not accountable to government, but to the minister. So that's quite an anomaly. So globally, following the global financial crisis of 2007 and 2008, not only in South Africa, but internationally as well, financial sector reform became a very big focus of attention. And it was driven by the poor practices that surfaced as a result of the global financial crisis. We saw inadequate regulatory oversight, so the cracks were beginning to show. And there were also a number of very high profile cases of poor practices in the financial sector. We know that the financial sector in South Africa is a core component and contributed to South Africa's GDP. Even though our sector weathered the storm of the global financial crisis relatively well, the sector could and should have produced better outcomes for customers. And so the global financial crisis spurred the regulators to introduce a policy document called A Safer Financial Sector to Serve South Africa, which was published in 2011. And that basically became the start of what is referred to today as the Twin Peaks model in South Africa, which is a complete overhaul of the system. And it's a complete system for regulating the financial sector. And it moved away from a kind of fragmented regulatory approach to a more a tighter regulatory system, focused on making the financial sector safer and to work more effectively in the interest of all South Africans. The focus is on reducing financial instability or threats to the system and protecting customers. And the Twin Peaks model basically gave rise to what we call the Financial Sector Regulation Act, and that was eventually passed by Parliament to the end of at the end of 2017. And I'll speak about the next step in the FSR Act in the next slide. And interestingly, over that period, South Africa also became the first country globally to regulate what was previously unregulated investment instruments referred to as hedge funds under what the Unit Trust Act, which is the Collective Investment Schemes Control Act. So that was quite an eventful period, the democracy period, until everything started or is slowly beginning to be put under pressure and some strain from an economic perspective. But the first step of the FSR Act was to split the regulatory space into two regulators. And so we saw two regulators come into operation, what we refer to as the Prudential Authority, which is part of the South African Reserve Bank, and the Financial Sector Conduct Authority, which is the old FSB. And this was the start of the implementation of the new Twin Peaks model of financial sector regulation in South Africa. Now, what subsequent, so that was from a regulatory perspective, from the financial sector, is currently under pressure to play a bigger role in supporting government because of our strained fiscus. And that's why the issue around prescribed assets has been in the market for the past 3 odd years, from when it was first announced at the NASRAC launch of the ANC election manifesto. So that was always on the table of the, it was coming and going, noise was there in the background, but then COVID-19 happened, and our very, very troubled and weak economy of poor decisions having been made around the economy of the past 10 years has totally plunged our economy into economic despair. And government saw this as an opportunity to consider reforms on how they can introduce a reform package where you also crowd in investment from the private sector and retirement funds. And so the government set up an office within the presidency, basically to package infrastructure investments and to introduce those investments to third-party funders, the private sector, as well as retirement funds, to crowd in funding in the form of blended financing for a revised fiscal allocation. And, we'll talk a little bit about this later on, because what this does mean is that certain regulations in the South African financial sector need to be amended to allow for institutions to invest in unlisted assets. So that kind of gives you, those couple of slides took you through our 400 years of history. But most importantly, I think I spoke about, I did mention this a few minutes ago, is that the crisis, the global financial crisis in particular, really exposed a range of vulnerabilities in the financial system, both domestically and internationally. In the US, we saw firms that were too big to fail being bailed out by the government. We witnessed the complex and opaque web of interconnections that exist between large financial institutions. We saw excessive leverage within the system, inadequate fiduciary standards within the system, and a lot of illegal and unethical activities had surfaced over that period, really perhaps threatening the public trust and confidence in the entire financial system. So the Twin Peaks model really is focused on creating this more harmonized system of supervision and enforcement to deal with customer complaints. It's there to also provide a harmonized approach on supporting, between the Prudential Authority, the FSCA, the National Credit Regulator, and the next part. So the reform process is going through several different stages. The first stage was the FSB Act got approved by Parliament. Then we saw the establishment of the FSCA and the PA. And the next phase of the reform process from a market conduct perspective will be to streamline and harmonize the legal landscape that financial institutions will operate within. Government introduced a single holistic legal framework referred to as the Conduct of Financial Institutions Bill, which is currently in draft form and going through, it's ended its comment phase, so we're hoping that we see a second draft of the bill come through. And this bill will basically give legal effect to several aspects of financial sector regulation. But what is also exciting about this bill, that it deals with issues that previous regulatory frameworks within South Africa did not deal with, is around the issue of competition and transformation within the financial services sector. And it deals with aspects of the financial sector code and how South African financial institutions need to meet transformation requirements. This is a very, very important slide, the liberalization of exchange controls and the prudential limits for retirement funds. talking about the history of the financial sector, Regulation 28 came into play in 1958. Exchange controls and the liberalization of exchange controls is really broken up into two periods: the pre-apartheid period and the period of democracy. The entire principle and objective of exchange controls was to limit the outflows of capital and focused on macroeconomic stability. But during that period before democracy, it was largely, exchange controls was extended because of our domestic political situation. External pressure was also placed by international countries. For example, in 1976, when we had the student uprising in Soweto, June the 16th, proceeds of the sale of non-resident owned securities were blocked and eventually converted into what was then referred to as securities rand, traded only at a substantial discount and at a lower exchange rate. And then the United Nations introduced worldwide economic and financial sanctions against South Africa in 1986. And there was a standstill on the repayment of a major part of South Africa's foreign debt. Indebtedness was introduced. And so that was ultimately the period of very strong exchange controls during the pre-apartheid period. And you can see following the democratic election for the new government of national unity in 1994, we began to see the relaxation of exchange controls. We saw international actions against the South African economy and government were removed, and there was general consensus within the ANC-led government that exchange controls should also be removed. There was a disagreement between the private sector and government in terms of how exchange controls should disappear. Naturally, the private sector felt that we should have followed a Big Bang approach, but it has been a process, and that process is clearly spelled out on the left-hand side in terms of retirement funds. And currently, South African retirement funds can invest up to 30% internationally and 10% outside of South Africa in the continent. So that talks to exchange controls. If we talk to Regulation 28 of the Pension Funds Act and the reason why Regulation 28 is in place, what this regulation does is it limits the extent to which retirement funds can be invested in different categories of assets. And the purpose is to protect members' retirement provision from the effects of poorly diversified investment portfolios. So this is done by limiting its exposure to more aggressive asset classes and as a means to protect investors so that they can save adequately for when they eventually retire. So the aggressive asset classes are basically the likes of equities, and that's limited at 75%, and unlisted investments currently, and alternative investments, hedge funds and private equity sitting at 15%. And if government is going to pursue some sort of blended finance partnership with the retirement fund sector, these numbers would have to be revised to accommodate for larger investment by retirement funds in the unlisted markets. And for those of you who followed our Minister of Finance speech about 2 weeks ago, some announcement was bound to be made, and someone pulled it out of his speech. So we do believe that some kind of announcement is imminent to allow for retirement funds to invest alongside government in unlisted infrastructure projects. This is also a very important slide which demonstrates the drop in exchange controls, the removal of exchange controls, attracting foreign investment and deepening both our equity and bond markets. Of course, we most recently, if you look at this part, the last 10 years, we've seen the exit of international investors from our debt and equity markets, and you've seen the decline in the rand. So you can see that the rand weakens substantially every time there are major disinvestments from the domestic equity and the domestic bond markets. But once South Africa came into the globalized space and we were welcomed by international countries post-apartheid, there were more, we opened up to the markets, we became part of this global space, which also saw the establishment of many foreign banks starting to base themselves in South Africa, which promulgated also a major restructuring of the financial sector. So exchange controls were basically lifted to some extent, and we were now a liberalized economy, and international investors could invest in the South African market. So we saw an increase in liquidity, we've seen an increase in activity, we've seen the increase in foreign ownership, and of course this spurred during the golden age of foreign investment on the JSE and the bond markets. So everything above zero here is all the money that came into our markets, and every time we saw a decline or disinvestment from our South African markets, we saw a spike in the rand, and those periods are very evident. This was basically the Asian crisis, followed by the dot-com bubble. Then we had the global financial crisis, where we saw a big drop in the markets. And of course, the Zuma years has introduced significant amount of volatility, a decline in the rand, and with the COVID crisis, you saw massive outflows from our market, particularly our bond market during the period February and March. And that led to a significant decline in the rand. The rand is also one of the most liquid emerging market currencies in the world, and often used as a proxy for emerging market volatility. This is quite an interesting slide. What it speaks to, it says that in 1990, there were 14,610 registered retirement funds in South Africa, and currently there are only 5,149 registered retirement funds in South Africa. And it speaks to the regulatory drive by the FSCA to reduce the number of standalone retirement funds in favor for umbrella funds. Now, umbrella funds are legal structures sponsored by financial institutions where they have institutionalized the fiduciary responsibility through boards of trustees and provide the governance structure, and employers can basically participate under that umbrella arrangement. The head of the FSCA of the retirement fund space, Olano Makubela, recently at one of industry gatherings a few years ago mentioned that government would like to see the number of standalone funds decline to all the way to 200 through such form of consolidation. We're really concerned about the consolidation of retirement funds in South Africa, because placing the trust in the hands of the large financial institutions only creates more concentration within an already concentrated sector, and it also takes away the governance associated with individual pension savings, as well as it takes away, it just kind of breaks away the member and the investor in the retirement fund industry from, you kind of more intermediated through the umbrella arrangement. Also, the umbrella arrangement is not supportive of a transformed model for savings in South Africa, because the umbrella model is largely supported by the large financial institutions, which would limit the participation of independent black firms within the financial sector value chain. This is a very, very, very interesting picture. It shows you the split between public sector workers and private sector workers. So what you see is currently there are around 15 million private sector employees that contribute towards the retirement fund, formal retirement savings, with the balance made up of public sector employees. So the ratio of private sector employees to public sector employees is around, 1 to 15, somewhere there. Even though the private sector employs more than 5 times the number of workers in the public sector, the assets of the public sector is now almost the same as that of the private sector savings. In 1990, that ratio was sitting at 75%, but now public sector savings in the retirement fund industry is sitting at 57%. Now, this is really the Achilles heel of the South African fiscus, and we know that in the 2018-19 spending on compensation of state employees accounted in excess of 35% of our national expenditure. Government wages in South Africa as a percentage of GDP comes in at around 14%. The global average is 10%. Compensation for government employees is the biggest component of public spending. It's grown faster than any other category except payments for financial assets. And it's really putting a lot of pressure on government expenditure. Just between 2006 to 2019, the compensation in the main budget towards public sector wages increased from around 154 billion to over 516 billion, 18 billion rand. Just to put this into perspective, the average salary increase public sector employees have received since 2010 has been 8% above inflation, and in the private sector it's averaged around 7%. Over 100,000 people work at Transnet and Eskom. And the World Bank recently said that it felt that Eskom was overstaffed by around 66%. The average salary in the private sector is currently sitting at about 273. In the private sector is around 270,000 rands a year, whereas in the public sector it sits at about 350,000 rands. And this is really causing a lot of strain on our fiscus. Our finance minister recently announced that he wants to adjust the public sector wage bill by an ambitious 160 billion over a period of 3 years. And we're beginning to feel the pressure. I mean, the public sector wage bill has also been the result of our downgrading and our inability to deal effectively with trade unions to reach a compromise on our debt. So it is putting a lot of pressure on our debt. But it also shows that it's a big contributor towards the savings of the assets of the Public Investment Corporation. If we move on to the collective investment schemes industry, which is largely an industry for retail investors, but institutional investors have started to play a bigger role within certain asset classes. What this graph is showing you currently is that we have around 1,625 registered domestic unit trusts and 504 international unit trusts in South Africa. So we're seeing the growth from 2000 all the way to 2020. Over a 20-year period, the number of unit trusts have grown from 273 all the way to 1625, and from 183 global portfolios to around 504 global portfolios. In recent years, particularly over the past 5 years, the domestic markets have contributed flat returns, particularly the equity markets, flat returns to any investor. And so South African investors have increasingly increased their allocation towards global investments. One, because the South African investment environment is not providing sufficient opportunities. We're not seeing value unlock coming through. Most of the action is in the liquid counters on the JSE. And of course, if you want to invest in big stocks such as Amazon and Tesla and Microsoft and Pfizer and the big global multinationals, to get exposure to an Apple, etc., you've got to invest offshore. So we still have exchange controls in the retail sector, so individuals can invest up to R1 million internationally without the need of a tax clearance certificate. Otherwise, you've got to apply to the Reserve Bank for your tax clearance for that 10 million rands a year. What we are noticing is that a lot of individuals over the last couple of years have increasingly started investing their savings in offshore unit trusts and funds that provide you with the maximum offshore exposure. One, because South Africa has been weak. Two, because it's a rand hedge. And three, you're getting access to a greater pool of investments. I'm going to move quite quickly. I see I'm falling slightly behind here. This just gives you an indication of what we refer to as the MANCO industry in South Africa, which is the regulated vehicle to be able to register collective investment schemes. What is interesting here is that a company such as Allan Gray only has 11 registered unit trusts, but holds 11% of the market. You can see Coronation has got 23 unit trusts. They control 10% of the market. Someone like BCI only controls 4% of the market, but makes up 312 of the number of JSE, the number of unit trusts registered in the market. And this really comes from the practice of white labeling and what we refer to as co-naming agreements. So before the Collective Investment Schemes Control Act was enacted, the practice of white labeling has become very popular in the unit trust industry. Essentially, this meant that certain businesses that had no capacity or intention to register a collective investment schemes MANCO would basically use the license of another registered manager to register their fund. And so the likes of a Prescient and the BCI, they are third-party white labeling collective investment schemes MANCOs, who registers the unit trust of other asset managers in South Africa. If we see the top 15 MANCO market share of the past 5 years, they mostly held what we refer to as airport companies, guys who advertise at the airports. So you've got Allan Gray, Coronation, Investec, now referred to as 91 Asset Management, Net Group, who have all maintained the same position over the past couple of years. I see Ford has fallen off the radar here a little bit. Momentum has gone through a tough period, and we've seen recently we've seen Discovery coming into the fold of the top 15. What is most interesting here is it also speaks to the concentration of the financial services sector, as well as the lack of transformation in the financial services sector, which I will talk to in a little while. In fact, this picture speaks to that dynamic quite clearly. The South African financial system emerged out of what we refer to as the bank assurance model. For example, the ownership relationship between Sanlam and Absa, Old Mutual and Nedbank, Liberty and Standard Bank, Momentum and the First Rand Group, and money makes money. So you've got an oligopoly structure, which is not good for competition and for customer value because of the lack of competition in pricing. But what's really what we've really seen over the last 15 to 20 years is the emergence of independent firms. Historically, asset management firms were always part of life insurance businesses because they manage the assets of life insurer balance sheets. And from the emergence of the likes of Allan Gray, Investec, Coronation, those were all independent asset management firms that had no links or ties to any insurance company. And since then, we've seen boutique investment managers emerge, and we've also seen the growth and development of Black-owned, managed and controlled asset management firms. One could argue that South Africa never really conceptualized a new economy that promoted large-scale participation by all the citizens of its country. The economy really retains some form of its colonial heritage structure where a few companies dominate all key sectors, and the picture is really so in the financial sector. So even though we have a lot of new players in the market, the historically dominant players still control the lion's share of assets as well as financial activity within the sector, which leads me on to my discussion around a transformation of the financial sector. And, this was really spurred by the FSB Act, which came into play in the early 2000s. And what happened in 2002 was that the sector got together at NADLAC. The social dialogue was held between the various partners, government, business, labor, community constituencies, and a financial sector charter was ultimately negotiated and came into play, which was then followed by various iterations of the financial sector code. And in fact, we're currently sitting in a space where the current code that was gazetted on the 1st of December 2017 is again under review, and we should see another iteration of that code come into play quite soon. The whole purpose of the financial sector code is largely to facilitate financial inclusion and transformation, to broaden the participation by all in the sector, dealing with ownership and control of financial institutions, dealing with the financing of Black businesses within the sector. We want Black people to participate in the sector. We want Black leadership. We want the procurement of goods and services from Black-owned companies. And, you know, we'll continue to see this legislation evolve as we monitor the pace of transformation within the sector. You know, the sector has also been, our sector in particular, has been extremely innovative. You know, as the Association for Black Securities and Investment Professionals, we were the first to bring to the table the idea around Black business growth funding and how it could be used for equity equivalence and empowerment financing to further and enhance transformation imperatives, and has subsequently been included in the financial sector codes. Of course, the codes have been open to manipulation and abuse, and we've got the BE Commission, whose role is to ensure that that does not take place. So just something that you know, we have played an active role in the economy has been to introduce and incubate Black asset management firms. And you can see the growth in the number of Black-owned, managed and controlled asset management firms since 2009 has grown all the way to 50 firms, and the size of the assets has grown from around 91 billion rands all the way to that 579 billion rand mark, which is still very, very little when you compare that number to the 7.6 trillion rands that I spoke regarding savings stocks in South Africa. The growth has been good. What we're really concerned about now is the saturation in the market, the decline in the economy, the level of retrenchments, the disinvestments from the market, the increase in competition. And so we are expecting to see further consolidation and attrition within this market, given the current state of the environment. You know, this is a very interesting picture. What we're seeing globally and the trend in South Africa as well, we're seeing a decline in the number of shares listed on exchanges. I mentioned earlier that in 1890, we had 300 shares listed on the JSE. And if you look at where we are today, we've got 330 shares listed on the JSE. It's declined all the way from 700 shares just in 1990, all the way to 330 shares where we're currently sitting at the moment. You know, the problem with having had one exchange all these years was that, you know, it's incredibly expensive to list on the market and to maintain a listing, even though the regulatory environment has changed to allow for other exchanges to come and play in the market. You know, the current environment is not conducive for those exchanges to thrive because there are no new listings coming to the market. Increasingly, companies are finding alternative sources of capital to be able to grow and expand their businesses. The JSE has also become an incredibly concentrated market. You know, if you look at the big caps, you know, Prosus, Naspers, MTN, British American Tobacco, etc. You know, they control 40% of in excess of 40% of the market cap, and so outside of the big liquid counters, there's very little investment opportunities. The spreads are very wide. The mid-cap sector value unlock has not come through for a very long time. And increasingly, what you're seeing all over the world is the rise of private equity in the private markets. And you can see from the triangle on the right-hand side is that the listed markets, the pink part, is a very small component of the overall number of companies that participate in the functioning of the economy. And what we are beginning to see, the green curve on the left-hand side, is the growth of the private equity market in South Africa. And private equity can, in fact, play a phenomenal role in an emerging and a developing economy as South Africa, where it can be used to successfully provide economic growth and good developmental outcomes. And there's several work that has been published in this space. And in fact, we commissioned a research in the space where we've demonstrated that private equity does support economic growth and expansion. And you know, one good example of that is a partnership that we've entered into with, for example, the National Treasury Jobs Fund, where we focus on investment in private equity to create jobs in the economy. And we're going to see increasingly more money going to private equity investments. And I mean, just last week, the sale of Edcon was announced to the likes of a private equity investor. And you'll be surprised that a lot of brands, household brands that you know of, have been supported by private equity investments. I mentioned earlier that our president has set up an infrastructure office within the presidency to coordinate infrastructure investment through partnerships. The thinking behind this was to have a well-coordinated and institutionalized infrastructure delivery mechanism that involves public-private partnerships. An infrastructure fund is now being set up that focuses on projects which require partial government financial support to be commercially viable, and creates mechanisms for blended finance institutions and multilateral development banks. And the idea behind this is to mobilize and maximize private sector investment and use government funding to fill the funding gap. So you can see that government has identified a total of around 270 projects, total of 2.3 trillion rands. They've got a funding gap about 502 billion rand is where the infrastructure fund will come into play, and they expect to create a total of 1.8 million jobs out of this fund. They've identified several sectors and projects that will be able to facilitate aggressive job creation, which is in the areas of energy, water and sanitation, transport, digital infrastructure, human settlements, agriculture, and agro-processing. So a symposium was held towards the end of June, and I believe that the next step is really to crowd in private sector and retirement fund capital, which speaks to what I spoke about earlier on, that for that to successfully happen, we're going to need some form of change in the regulations to be allowing retail investors as well as pension fund investors to be able to invest in unlisted assets. A point that I'd like to make, and which is connecting to the slide on the previous page, was, you know, the JSE doesn't provide sufficient access and sources of investment opportunities anymore. You know, increasingly we're looking towards private markets to be able to provide investment returns and sources of alpha generation. You know, the decline in the number of counters, the lack of diversification, the increased opportunities to have an impact on the economy as well and contribute towards the challenges we face in the economy can be achieved through some form of investment in the private market space. Very, very important. I'm going to end off with the next two slides. So I'm close to the end. And I want to talk about environmental, social, and governance, which is becoming the underlying pillar and foundation of everything in the investment industry. You know, we refer to as environmental, social, and governance criteria, which are basically a set of different standards that socially responsible investors use to screen potential investments. If you think around the environmental criteria, we need to think about how institutions, whether it's the private sector or government, performs as a steward of nature. Climate change, you know, tends to, you know, climate change efforts to cut carbon emissions linked to global warming have been a central focus of such efforts in the environmental space. And some of you may have followed recently is that climate change activists have been targeting Standard Bank in relation to some of their board members having links to fossil fuel investments. If we move on to the S part, the social element, the social criteria largely examines how companies manage relationships with employees, suppliers, customers, and communities within which to operate. And if you think here, you think the likes of Lonman, their role in the Marikana massacre. Most recently, you can talk about Facebook and their issues surrounding privacy, lack of transparency. What do they do with people's data? They collect people's data. Who do they share our user information with? Amazon has also been in the limelight and have been plagued by several class action lawsuits on wages and working conditions of the employees. If we move on to the G, governance issues, deals with leadership, deals with executive pay, deals with audit issues, internal controls, shareholder rights. A prime example would be the way independent non-executive directors lost sight of their role when it came to the likes of Steinhoff. Auditors were also exposed on their conflicts of interest. And what makes for very good reading was a report that's recently been released by Open Secrets around criminal activities relating to the audit fraternity and the corporate sector. So what has subsequently happened is just this year, National Treasury has released a technical paper which defines sustainable finance for the South African context and articulates a kind of shared vision for its implementation. It recommends future policy actions to promote the achievement of a much more sustainable economy and industry, and looks at ways of how it can effectively introduce ESG for the safety of the soundness and the stability of our sector. Towards the right, you look at some of the global industry efforts. One is the United Nations Principles for Responsible Investing. Then we've got the United Nations Sustainable Development Goals, which is a set of 17 global goals designed to provide a blueprint to achieve a better and more sustainable future for all. The SDGs were set in 2015 by the United Nations General Assembly and is intended to be achieved by the year 2030, which is quite a big task. So ESG is not something that we can ignore. And as part of the financial services sector and practitioners in the sector, both between asset owners as well as role players in the sector, we've got to ensure that we integrate ESG into how we make investment decisions and be a lot more responsible and accountable for the investment decisions that we made. And this is just some names, and I can assure you there are much more names globally, but some that have been close to our heart and has really impacted the poor and the ordinary South African. If you look at the savings of people, so many people lost their money when it came to the malfeasance and the corruption and the governance related issues at the likes of VBS Mutual Bank. We had issues at African Bank, ShareMax. Recently the FSCA took away the license of a listed company called Exponent, which was also involved in similar kind of activities. Fidentia, we can't remember that Fidentia stole from the poor. If we think about Enron, what happened in the US, and I mentioned Lonman earlier. We had the issues around corporate governance and Peter Moyo at Old Mutual. We've been having issues at South African Airways for a long time. We think about the BP oil spill. We think about Apple and the manufacturing of its products in China. And the issues surrounding employees there. And if we think about the 260 billion odd rands that ordinary South Africans lost from Steinhoff and what's happened on that front, if if you just look at this picture and as ordinary people investing in your retirement fund, we've got to make better decisions and hold people accountable. And so this is a process that will continue and will increasingly become more and more entrenched so that we can hold everyone accountable and deal with the financial sector that is a lot more stable than we've seen in the past. So that's a wrap from my side. I do apologize that I've taken more than I was meant to take, but I'm still around. And for those of you who want to ask me questions, I'm happy to deal with those questions. And I think, there's quite a few that have come through here, and we'll just go through all of them. So the first one is, so the first question I see there is, what is the fundamental difference between a unit trust and an ETF? So an ETF is a passive investment instrument that basically mimics any kind of index. A unit trust is a pooled investment vehicle that can hold anything in it. It can be active or passive. So the big difference between a unit trust and an ETF is one is passive and cheap. It replicates an index. The other one is a pooled investment vehicle that can invest in anything and a lot more flexible. The next one is there a possibility for local equities to recover in the next 2 years? Should we invest offshore? Diversification is critically important. Always diversify your savings between domestic and international, and also within asset classes. Don't have all of your eggs in one basket. Don't put all of your money with one asset manager, because then you are inclined to the investment views of that one asset manager, and they have a particular DNA or performance signature. You don't want to be in a position where their performance signature is out of favor with the cycle of the market. So try and diversify as much as possible. Stay away from the small cap counters, stay away from the mid cap counters. We don't think that SA Inc. is going to see a recovery over the next 3 years. The recovery is going to be slow and hard. If you are going to invest in the JSE, focus on the large cap counters. And then we've got someone who wants a change in career. What advice do you have for an engineer with almost 20 years in engineering who wants to switch in fund management? Engineering gives you very, very strong analytical and technical skills. You are able to run models. You are able to think laterally. And in fact, our sector, I prefer people who come from a mathematics and a scientific background, because our markets are increasingly more about big data. We talk about machine learning, we talk about artificial intelligence, and how can we use those type of tools more efficiently to drive investment markets and drive investment returns. So come on, switch from the engineering space into fund management. We will welcome you. Andrea asks, please could you give us some color on the quantum of funds that are invested offshore, their location, and what they are invested in? I would say about 30% of our savings stocks are invested globally. I would say that they're largely invested in the equity markets, and I would say that they're largely invested in the developed markets. As an emerging market, we try to stay away from other emerging markets because of the risk we faced during contagion, and therefore we tend to focus on investing in the developed markets to diversify our exposure between domestic and international markets. So the quantum of funds, many retirement funds in South Africa now maximize their global exposure. Similarly, a lot of the retail investors have maximized the global exposure. And in fact, unfortunately, we've seen financial immigration from high net worth investors, given the lack of confidence they have in the South African economy, and because of the policy uncertainty in the South African economy with regards to land rights and various other issues, have started financial immigrating, and we've seen huge amounts of capital leave our shores over the last couple of years. Lela asked a question, why is the financial sector so poor at financing development projects? I think it's really because Our DFIs have not been able to properly package developmental projects in a way that makes them attractive to foreign direct investment, as well as the private sector. So I'm hoping that this infrastructure office is going to do a better job, because nobody is going to want to invest in something that is not solid and provides a good pipeline of potential investment returns. Mlondolozi asks, regulation is necessary to ensure pension retirement assets are not managed recklessly. How effective has the regulation been in achieving sustainability and inclusive growth? I don't think it's been that effective. I'm going to be very honest with you. We've largely been investing. Sorry, I see something popping up on my screen. I don't know what that means. Okay, I've just minimized it. I don't think regulation has been effective in facilitating broader inclusive economic growth. The issue around stockpiles and the regulation around stockpiles is a discussion that's been happening for a long time with the regulator, and it is something that that the regulator is looking at. It may be interesting for you to engage with the regulator. Willem Boshoff, thank you for the compliment, much appreciated. I'm glad you enjoyed it. What methods, and Anonymous has asked why, how do you gain exposure to the private equity market? The ticket size for the private equity market for individuals is the minimum ticket size for the private equity markets is, around 50 million rands. And that's why we're pushing for the collective investment schemes market to introduce products where you could buy a smaller ticket size and you could put in a 500 Rand debit order and invest in the private markets. But please contact me outside of this, because we are investigating solutions on that. All right, so why, I've got a question here on quantitative easing and why is the Reserve Bank buying more bonds before we went into the crisis? It seems like that. So the reason why the Reserve Bank is buying more bonds on the short end of the market, we have a yield curve. The value of the curve is where the international guys play. The Reserve Bank needed to induce liquidity into the market at the peak of the COVID crisis at the end of Feb and coming into March. We saw that liquidity dried up and they needed to come into the market to buy the bonds to provide stability to the spreads in the bond market, because at some point we saw our 10-year treasury move to yields move to close to 13%. It's come back all the way to around 9.5%, but there was risk in the financial system, and they needed to come in and provide stability to that market. Is there any asset classes that's COVID proof? COVID-proof, cash was very attractive until we had a 2.75% interest rate cut coming into 2020. Before that, cash was fairly attractive. Our view is diversify as much as possible. Inflation print came in at 3% at the moment. Cash is still going to give you around 6%, so that's still a little bit attractive. But diversify, make sure you've got some aggressive assets that can give you upside, but then you're also protected in the downside. If I look at, there are a few questions here. I think I've answered all of them. What is your opinion on fees currently being charged in the retirement industry? Yes, I support hybrid models of active and passive investments. We need to bring the costs down. The overcharging of fees, the lack of clarity, the T's and C's, with the new POPI legislation, treating customers fairly legislation, we need to standardize fees in this industry. Asset managers have been earning too much for too long, and I'm hugely supportive of hybrid models of a passive investment where you can buy the index for next to nothing. And to be quite honest, passive has aggressively outperformed active over the last couple of years, but I wouldn't go either or. I'd say use some kind of blended and hybrid approach. Okay, sorry, I have to leave the presentation. Okay, someone says it's very cold in Cape Town. And someone wanted to understand how big was the private markets, equity market in South Africa. So that's sitting at about 173 billion. New statistics out from SAFCA will be published next month. which is the Venture Capital Association, and you'll find updated figures being launched next month. Do you think if the COVID crisis exposed cracks in the savings and investments industry? Yes, absolutely. It has exposed cracks. It's exposed cracks all round. And therefore, a cautious approach to everything you do is critically important. When we have a crisis, I don't think people understand that the COVID crisis was about 10 times more severe than the global financial crisis of 2007, 2008. We saw the Fed expand their balance sheet from 4 trillion rands at the end of December 2019 to around 8 trillion rands through providing through providing both monetary and fiscal stimulus into the US economy. Every country in the world has introduced stimulatory efforts. So did the South African government. We are concerned about excessive leverage in the system. We are concerned about excessive debt in the system and how that will play out going forward, because it's just a lot more worse and severe than we saw in the 2008 crisis. Having said that, there are opportunities abound, and one just needs to be careful and think about things and work with the right people, and ensure that they make astute decisions and not be reckless. So that kind of wraps up as many questions that I could deal with. If there are questions that I have been unable to deal with, please drop an email, info@27four.com. Visit our website, 27four.com. Follow us on Twitter and Instagram. Reach out to us. Happy to help, happy to respond, happy to have a follow-up session. Really excited to have been part of this conversation with my alma mater, Wits University, the greatest university around. So thank you very much, Yumna and Peter and team. Thank you so much.
Thank you very much, Fatima. Good afternoon, everyone. For those of you who might not know me, I'm Peter Marr, the Director of Alumni Relations at Wits. So this presentation was originally meant to take place on the 27th of March, Fatima. So we were overtaken by a pandemic in the meantime, but I think it's been well worth the wait. And the silver lining is, of course, that we've managed to get more people to come and join us this afternoon than we would have had if we had it at the Wits Club. So yeah, that's awesome. Fatima, that was a fascinating history and context of the financial sector, extremely educational and informative. I'm sure everyone agrees with me that they enjoyed it immensely. I'm very grateful to you for your time and expertise, your generosity in doing this for us. Thank you very much. Just a few words about Wits is you probably already know that we're in exciting times. We've appointed a new Vice Chancellor designate, Professor Zeblon Vilakazi. He starts when Adam leaves at the end of December. We'll be having a webinar for the global alumni community on the 29th of July. We'll be sending out invitations to that shortly where you can get to meet Zeblon. So we're looking forward to that. A huge thanks to Yumna Patel and my colleagues in the alumni office for putting this together. And a huge thank you to the audience, for guests, for joining us this afternoon. Thank you very much. Stay safe. Thank you. Thank you, Fatima. Bye-bye, everyone. Oh, please don't forget to fill in the poll questions. They've been popping up. Those are quick poll questions, if you don't mind filling them in. Yeah?
Give me 10 out of 10 for those questions.
Absolutely, 11 or more.
Okay,
Thanks,
cheers. Bye-bye.
Take care. Bye-bye.
Bye.